Hello and welcome. This is the Insurance Pro Blog Podcast. I am Brandon Roberts.
And I am Brantley Woodley.
And you are listening to the internet's favorite podcast about life insurance.
That's right.
Yep.
And we're actually going to talk about life insurance today.
We are. We've been doing that lately. It turns out that helps the downloads we've discovered. If anybody's out there looking for some tips about podcasting, talk about the things that are in the title of your podcast, kind of ish, and people will listen more.
Yeah, that's right.
And when people say, hey, dance, monkey dance, just dance.
That's right. We should have learned.
Mm-hmm.
Before I fail to mention it, since we're horrible promoters of all things, if anyone would like to talk to us about a life insurance policy they own, about one they're thinking about buying, or just, I don't have one, I don't know if I want one, but I'm thinking about it, you can go over to theinsuranceproblog.com, and in the navigation bar, there's a schedule now link or something like that. Schedule a call link, and you can have access to a calendar and book your own time.
And just so you know, a lot more work went into that than should have. So we're mighty proud of it.
That's right. I figured we should promote it at the top of the show. So there we go. All right. Commercial over.
So max funded index universal life insurance is the topic du jour.
Ooh. Us and TikTok. That's a favorite.
Yeah.
But well, sometimes we really struggle with the naming convention of these, terminology in our industry because we really hate it. What the sort of common vernacular has decided to call things because we just think it sounds incredibly corny, but we just have to go with the flow.
We do.
And max funded index IUL is one of those.
It's one of those terms. So here we are talking about it.
Yeah.
You might also hear this referred to as overfunded universal life insurance.
That's the old school term.
They're the same thing.
Yeah.
The exact same thing. Universal life insurance comes with some options, does it not?
Yeah, it does.
Like you've got a lot of liberty over how you treat the premium payment of a universal life insurance policy. Because for any level of death benefit, you can pay pretty much nothing up to some sort of maximum, which is, for most people's practical purposes, the maximum before the policy turns into a modified endowment contract.
Right.
And so you get to bounce around with universal life insurance.
Yep.
And
turns out the premium actually is flexible.
It is. Now, we should tell you that if you're looking at a proposal for universal life insurance, index universal life insurance, the fact that you can make adjustments to the premium isn't always something the agent you're talking to is going to tell you about.
Right. That is true.
So when you buy $1 million of universal life insurance, the agent might tell you that, well, you're going to have to pay $12,000 a year for that.
Right.
And you might just decide, okay, I have a $12,000 a year life insurance policy. I have to pay $12,000 a year for my life insurance policy. But the truth is you can pay more than that.
Yep.
And universal life insurance gives you extreme flexibility on that side of things.
Yep.
Now
you can pay less for that too, by the way.
You totally can.
For a limited time, probably. But I mean, at some point you're going to have to pay. But
now this differs considerably from whole life insurance, where there is actually a premium you must pay.
Yes.
And the only way to pay more is through a paid up additions rider, which gives you flexibility that is similar but not identical to universal life insurance.
Right.
Now, I think having this discussion, there's probably a group of people out there. They've maybe listened to a couple Insurance Pro Blog podcast episodes. Maybe this is their first one. Welcome, if that's the case for you. And you may be thinking, why on earth would I give the insurance company any more money than I have to?
Yeah. That's a good question.
And the answer is because if you do that, we get more money and we like that. So just give us your money.
That is not the answer. That is a answer.
That
is not the answer.
And we don't get that much money when you put more money in there. Actually, it's very, very, very little.
Yes.
The reason you would do that with an indexed universal life insurance policy in particular is because all of the cash that you pay into your policy in excess of the expenses, which are quite small in most cases, is going to go immediately to the cash value of the universal life insurance policy.
Right.
This means that you now have cash that will participate in whatever the interest component of the universal life insurance policy is. And when it's an indexed universal life insurance policy, most of the time, that's going to be the indexing mechanism.
Right. Right.
That's the thing that pays you an interest rate based on the movement of some sort of index.
Yep.
So it could be the S&P 500, for example.
Yep. Let's think of a live example, because I think using numbers in an audio podcast is always awesome and people love it.
Air quotes are too,
I think it's
gotta hit all the classics.
I think we should share a little bit of our institutional knowledge, if you want to call it that.
Ooh.
And I do want to call it that. That's why I brought it up. To explain what we're talking about. So I think, at least writ large, most conversations about life insurance start with, you need X amount of death benefit. We've done a needs analysis, and we've determined with all the things that you want to do in your life, if you were to drop dead, then your family would need $2 million.
Yep.
To make that happen. So we think this is the best policy. This is an indexed universal life policy in this case. And so that $2 million policy comes with a $20,000 a year premium.
Okay.
How do you feel about that? Like,
I feel great.
Yeah, exactly.
Said the guy role playing and no one else ever.
So I said all that to say that is never how we approach an indexed universal life policy. So that's the standard death benefit first, and then we figure out what's the, I'm going to use air quotes, which are also effective on an audio podcast, minimum premium required for a $2 million death benefit in an indexed universal life policy. And that might be something like $20,000.
Yeah.
On the other hand, the way that we typically design indexed universal life insurance policies is, what sort of annual budget were you thinking of allocating towards this purchase? Which, to be honest, confuses some people.
Some?
When we asked them that.
I think you misspelled all there. But,
feel free to jump in here, Brandon.
No.
But no, seriously. Because I'm doing this live on the fly. I didn't have a plan to do this. I'm just
No. I'm just making a joke about it. It confuses some people. It confuses all people. It very much is a reverse thought process, which confuses people because it seems backwards.
Yeah.
When they say, I want to buy indexed universal life insurance because I've looked at it and I think this is for me. And they come to us and we ask them a bunch of questions. And then we say, okay, so have you thought at all about how much money you want to commit to this? Like, how much do you want going in there every year or month or whatever it is that you plan on using as the frequency with which you pay into this thing? And they go, well, I hadn't thought much about that. I thought we were going to talk about how much life insurance I should buy, which we can do. We totally can. But if we're trying to maximize the cash value accumulation of a life insurance policy, which is what you would be doing if you were talking about max funded indexed universal life insurance.
That's where I was getting to.
The death benefit, I mean, if you need a certain amount of death benefit, you need a certain amount of death benefit, and we can talk about what that looks like. But speaking from the institutional knowledge previously referenced, most people are probably not going to want to target the needed amount of life insurance that they need outstanding and then try to max fund that policy.
Right. Exactly.
Again, not saying it can't be done, just saying that I haven't met that many people who go, oh, that sounds like a decent amount of money to put in there.
Yep.
because that might realistically...
We could probably count on one hand the number of people who have agreed to that.
And it dawns on me that this may seem a little esoteric. So let's go back to your $2 million example to say your $2 million death benefit on an index universal life insurance policy might have a max funded premium of like $175,000 a year.
Right. Exactly.
And somebody hears that and goes, well, that's cool, but I only make 125.
Right.
Or something along those lines.
No,
and
they'll come back with, no, what I was saying was like 20,000 would be the most I could spend on.
Exactly. And so what we want to do instead is say, well, then let's make the death benefit be the amount that would at a maximum accommodate that $20,000 amount you want to put into the policy.
Right.
Which is going to be a death benefit much, much lower than $2 million. And if you happen to need $2 million of death benefit outstanding, then we look at term insurance to get you to $2 million. Term insurance attached to the universal life insurance policy, by the way. No. A separate term life insurance policy for that purpose.
Yeah. And that may look something like $18,000 ends up going to the index universal life policy, and $2,000 goes to pay term insurance premium.
Yep.
And the death benefit on the index universal life policy may be $350,000, and the term policy is $1,650,000.
Yep. That could,
but that's going to be a much more efficient use of your dollar.
Yeah. And versus
buying a $2 million
yes
IUL policy and paying $20,000 a year.
Because the expense of that death benefit in universal life insurance policy, unless you really think you're going to end up putting a lot more money in that policy at some point in the not too distant future, it is going to become prohibitively expensive from the standpoint of accumulating cash value.
Right. So that's what, to me, when I hear max funded index universal life insurance, I think about, okay, max funded means for the given amount of premium that a person is going to pay, what is the minimum amount of death benefit they will have to stay underneath the modified endowment contract limit?
Yep.
Thereby increasing the efficiency of the growth of their cash value.
Correct. And this speaks to partially the question, why would you want to do that? Well, let's talk about the indexing aspect of this to say that, as an example, there are definitely index universal life insurance policies out there right now that would follow the S&P 500. They'd give you a maximum of 12% because that's the cap on the S&P 500 index account. Right. So that means in any given year, the cash value that is inside your indexed universal life insurance policy can be anywhere between 0 and 12%.
Right.
And since the market goes up more years than it goes down, it's going to be somewhere in that range of a positive number most of the time.
Mm-hmm.
And quite frankly, given the way the market moves, it's going to be 12% way more often than you'd think.
Right.
And that means that if we keep putting as much cash in there as possible, we're building the pot of cash larger and larger and larger, and it continuously gets to earn that potentially 12% interest payment.
Right. Exactly.
Which is a fantastic interest payment to receive on a very low risk asset.
Yep.
Now, there are some people who will hear this and say, well, okay, so it sounds like the execution, if done perfectly, is I start by thinking about the amount of money I want to put in there.
Mm-hmm.
But I didn't do that. I just bought index universal life insurance. So what do I do now? And there's two possible answers. The one is we find out what the maximum amount is that you can pay in there, and you do that, or some number larger than what you're paying in there, assuming that you have more money to contribute to it. Like, that's an option. One of the very, very cool things about universal life insurance, unlike whole life insurance, is if it was executed somewhat incorrectly, you at least have the flexibility to decide, well, I'm just going to put more money in there.
Yeah.
And you can do that.
Mm-hmm.
The other potential option, which is a bit more easy to do with universal life insurance than whole life insurance, is decide, well, I'm not going to put that maximum amount in there because it's just too much. But maybe I should reduce the death benefit on this universal life insurance policy, which you can do. And then I still want the death benefit, so I'll buy a separate term policy.
Right.
But that is a way that I can further optimize the cash buildup in the universal life insurance policy. Those are absolutely options that you can entertain.
Yep.
So when we say max funded, we simply mean that we're taking advantage of the entire contribution allowance. Think of cash value life insurance. This is true for universal life insurance and whole life insurance. Think of it in terms of every single year you have an allowance that you can put into the policy and maintain all of the really cool tax benefits that life insurance affords everyday Americans. And we are simply trying to use up that entire allowance when we talk about max funded or overfunded universal life insurance.
Right.
The other kind of nifty, somewhat geeky side comment here is that if you don't use all of that allowance, you do get to use it in future years with universal life insurance.
Right.
So if, again, you're somebody who says, well, darn, I bought this policy 5 years ago and I've been paying $10,000 a year. It turns out I could be putting 35 in there.
Mm-hmm.
And I haven't done that. You actually can contribute a substantial amount of money to that policy if you want to.
Because it's cumulative.
Yep. You could. And there's even more nuance to what the right decision may be. It could be a little bit of a reduction in death benefit plus a large lump sum into the policy. Those are all options that are on the table when it comes to navigating a universal life insurance policy.
Right. And you will not have that option in a whole life policy. No,
not nearly to the degree that universal life insurance will afford.
Right.
So the big takeaway aspect here is that max funded does mean that we're trying to put every dollar we're allowed into the policy. But if you own a policy where you haven't been doing that, it's possible for you to catch up to that point.
Yep.
Or make some adjustments to the policy to make catching up to that point more likely.
Yep. So let me ask you a follow-up question.
Okay.
What would be in your mind, what would be the key advantage to, we've talked about how this accelerates the growth of the cash value, and you've talked about, the risk adjusted rate of return being stellar. What would be the long-term benefit of accumulating lots of cash value in your life insurance policy?
You're probably looking at holding an asset, a fairly low risk asset that has an expected rate of return of like 5 to 6%.
Right.
So that would be money weighted rate of return in this case, because
which means
you're making continuous contributions to the policy. Yeah. Money weighted rate of return is really the rate of return we should all be talking about for the most part when we talk about retirement assets and things like that we are systematically making contributions to.
Right.
So a lot of people like to confuse compound annual growth rate with money weighted rate of return because compound annual growth rate oftentimes looks better.
Yeah.
But compound annual growth rate requires you to have all the money you're ever going to invest right now at the beginning.
Yep. And
so if somebody says this investment, let's back out from insurance for just a second, achieved an 8.5% CAGR over the last 20 years.
Yeah.
And infers that if you started contributing $10,000 a year to this, you too could have an 8.5% return on your money. Wrong. Very wrong.
Way. Yeah.
Because if you were to make contributions to that same investment over the same 20-year period versus having all of the money right at the beginning, your calculated rate of return is not 8.5%. Sorry, it doesn't work that way.
Right.
It's going to be less.
Yep. Because you're going to be buying at prices all over the map.
All over the map, and not all of your investment is in there from the very beginning. So time matters.
Yeah. Exactly.
Now, the one little caveat that I want to bring up here is the fact that if you own a universal life insurance policy and you either started it from the beginning paying the maximum premium or you found out you could some years later and started doing that, there are a few other things you should probably do. Well, not probably, that you will have to do as best practices to sort of benefit from all the things the universal life insurance policy can afford you. So max funding a policy is great. That's where you want to be. But there are some other things that you need to have at least on the horizon take note of these, because they are going to probably impact life as things go on, as things age, for example. So you will likely reach a point in your life where you decide, I don't want to pay premiums anymore.
Yeah.
And when that happens, there's certain things that you have to do to the policy to adjust it, so to speak, that will make for best accumulation moving forward from that point.
Assuming you're not going to put any more money into it.
Yeah, correct.
Yeah.
And there's a part of me that wants to go off the deep end of explaining all of those things and what they are, but I realize that there's a small percentage of the population that will understand anything I'm talking about. So,
and even less that will retain it. So,
it's not a complicated thing at all for a skilled insurance agent. It's just something you got to do. So understand that max funding's great, but there are a couple things that need to be done at some point in the future that will also ensure best accumulation. And if you're super duper curious about what that is, again, the scheduled time with us thing that we put so much effort into and we're very proud of, use that. Contact us. We'll take care of what you need to know.
Yep. There'll be a link in the description as well.
Yep. So with a max funded universal life insurance policy, you will get a relatively high returning low risk asset.
Yeah.
Like, I've been around for quite a while now, and I've tried to find other things that will rival what indexed universal life insurance brings to the table per unit of risk.
Turns out we'd love to sell something other than life insurance.
And we would. Come on.
Kidding.
I've got an audience on the internet. People listen. Well, some people listen. And it seems like, we could just talk about something else that has more appeal. But turns out roads lead back to life insurance very quickly a lot of the time.
Yeah.
So it works. It does a fantastic thing.
Yeah.
And it does it with incredible tax benefits.
Mm-hmm.
So the accumulation is tax deferred. The distribution can be income tax free, and the contribution limits on life insurance are wildly larger than IRAs and a lot of other qualified retirement accounts.
Yes.
So you've got the ability to put a pretty decent amount of money away and still maximize the tax benefits of the contract.
Right.
And life insurance in particular, whole life and index universal life insurance, both fall into this category. They create really stable returns year over year. Yes,
Mm-hmm.
I realize indexing is a little more volatile, but it's not that much more volatile. And the ability to generate income is quite substantial because of that lack of volatility.
Yeah.
So people often want to know, well, okay, if I'm going to use life insurance as one of my income strategies for retirement, like what can I assume will happen? And years ago, I used to want to run the illustrations because I thought there was some sort of magic happening. I didn't really think that, but most people did. The truth is we can just kind of take the numbers and do the math, which is what I've done for this example here. So if you were going to contribute $30,000 a year to an index universal life insurance policy for 20 years and achieve a 5.5% money weighted rate of return, which is exactly in the middle of what I said, 5 to 6%, you'd have a little over $1 million in accumulated cash value.
Right.
And from that, I would argue quite strongly that you should be able to produce income for your lifetime, starting at retirement, about $62,000. And that's $62,000 net because there's no taxes to fuss with. And all of the expenses have already been factored in. So $62,000 is what you would walk away from in that deal.
Mm-hmm.
If you want to draw a comparison to being in the market, for example, and using something like the 4% rule as your withdrawal rate, you're going to need a net rate of return above 9% in order to accomplish the same amount of income. And that's not factoring in taxes.
Right.
So
you're being nice, in other words, is what you're saying.
I am. If this is a taxable account, you're going to need substantially more.
You're going to need more than 9. Yeah.
And this
How
is one
much
of the
more?
reasons.
Well, that depends.
And this is one of the reasons why life insurance becomes a much more attractive option for people with higher incomes.
Yes.
Because we have a progressive tax system. And the more money you make, the more problematic taxes come from I need to net out a certain amount of money perspective.
Yep. And in our experience, higher income earners typically have higher incomes in retirement as well. So
yep,
they don't escape the tax problem.
They do.
When they retire.
That's not to say that they're going to have an identical tax liability in retirement to what they had while they were working. That doesn't always hold true.
Sure.
But they are likely to have some tax liability. And it does require more money or more tax efficient money when it comes to the retirement income plan.
Yep.
Because
it also works really well as a bridge. I know we have some clients who have talked about doing this. I don't know that anyone will necessarily, but we've had discussions where these are people who have done well in life and they want to retire before their 60th birthday, probably sometime in their 50s. And that's great. The issue they have is, many of them have 7-figure or multiple 7-figure balances in qualified retirement plans that they can't get their hands on.
Yep.
Easily. You can get your hands on it. We know. Don't send us the mail saying, well, what if you did this? And what if you did? Yeah, we know. We understand. But by and large, it's a lot of hoops to jump through. And it's not very efficient, no matter what. And so, but my point is, there are people that could say they funded their policies well enough to have a substantial cash value so that they could use some of their life insurance cash value to bridge that gap. Say they wanted to retire at 55 and they're like, well, I do, but I don't want to touch the 401k money, the IRA money, whatever, until I'm 60. And so I need something that's going to help me bridge the gap. And life insurance cash value is great for that because it doesn't care how old you are.
I have two things to add to that. One, total. Let's take a little loop here on our journey, because you mentioned the fact that yes, there's other things that you could do. We are aware of those things, and a lot of people in the financial advising world or the investment world or retirement planning world will bring those things up. So the 72 time. Distributions, right? You could do a 72T distribution, and that, yes. Have you ever done a 72T distribution? Because as somebody who's actually helped somebody do it, let me tell you, it's easy to talk about it. It's something else to keep records for it.
Yes. Exactly. So many strategies that are publicized. I sort of laugh at them, not because they're not valid, but it's not as simple as it's made out to be. And two, I mean, you and I have chased down many, many rabbits in these alternative strategies for people, analyzing them, looking at them, doing the math. I can count on like 2 fingers the number of people that said, yeah, that looks like a great deal.
Yeah.
Usually you do a lot of, there's a lot of calculation, a lot of work that's done to make sure that everyone understands what they're looking at. And then they look at it and go, yeah. That's not what I was hoping it would be.
Right.
So
that's nice, but it sounds a little complicated, and it's gonna require some work. That's gonna
and the money that I get from it's just not
right,
not substantial enough to
make the time of my life that I'm supposed to be enjoying a little bit less enjoyable.
Yeah, exactly.
Point 2, which piggybacks on all of this. Oh, well, actually, before I get there, the amount of record keeping we need for life insurance distributions, nothing. They send a 1099. They do. And people ask, what is this? And we tell them, look, the taxable distribution amount is 0. That's all you got to fill in. If you're doing your taxes on your own, you're fine. If you're bringing it to a preparer, they're going to know what to do. It says 0, you're good. They do it because we got to follow the money, mostly for money laundering purposes, or anti-money laundering purposes. The next point, which piggybacks
slight
on
distinction
that.
there.
Yeah, a little, details. The next one that piggybacks on all that just in terms of the bridge aspect, because bridges could be, I'm not yet 59 and a half, but they could also be something like, well, I'm thinking about doing Roth conversions.
Yep.
But I'm also trying to avoid IRMA, but I need income. So I want to do Roth conversions, and I need to be able to generate some income, and I don't want to pay astronomically high Medicare premiums.
Right.
So life insurance distributions temporarily could be a way to have funds to do what you need to do in retirement, do the conversion, and not run into an IRMA problem.
Right. I hadn't thought of that.
That's it. That's all I got.
That's a good one. That's a good one.
Yay. It's always good when I come up with one on the fly, isn't it?
Yeah. Right at the end. I think we've reached our expiration date.
Yeah, that's all I've got for today.
Me too.
So I am Brandon Roberts.
And I am Brantley Whitley, reminding you, if you'd like to talk to us, use the schedule button on our website or in this podcast description.
We can't wait to talk to you. And we will see you next week.